It's 4 o'clock in London because we've had a bit of a time change over the course of the last week, ladies and gentlemen. It's midday in New York, 12 midnight in Hong Kong, 3 a.m. in Sydney, 9 a.m. in San Francisco, 9:30 at night in Mumbai. Greetings, good morning, good afternoon, good evening, depending on where you are in the world. My name is Patrick L. Young, the IPO-VID Livestream, Series 27, Episode 2. In the aggregate, that makes a magnificent, one of the most beautiful Alfa Romeo designs ever. Episode 158 starts here. And we begin with, well, very, very long hours indeed. The New York Stock Exchange, their ARCA division, they're looking to extend the trading days. No longer will they trade 4 a.m. to 8 p.m. They hope in the future to start at 1:30 in the morning and trade all the way to 23:30 in Eastern Standard Time at night, dovetailing pretty much all of the world with just a bare 2-hour break to get the systems ready for the next day's trading. Exciting times, and driven, of course, by the innovation of blue ocean technologies. Catch our excellent IPO vid in the archives wherever you're watching this today. We had a superb interview with Brian Heintman a number of months ago on IPO vid talking about that. And also, indeed, we were talking to, one of their leading investors as well in another show, but that's for a later segment. ASX, ladies and gentlemen, well, a first strike for them. It's a sad sign of how far the mighty Australian monopolist exchange has fallen. Shareholders are finally becoming vaguely restive about payment for failure. Over in Japan, the Tokyo Stock Exchange has an embarrassing moment. They have an employee who has been accused of alleged insider trading, helping authorities with that. And then, of course, we have that fascinating conference at the weekend. Read the Western media and they'll say Vlad has no friends, yet 32 different nations, plus the UN Secretary General turned up at the weekend in Russia in order to participate in the BRICS summit. What were they talking about? Multiple exchanges apart from anything else. They're talking about a precious metals exchange, a grains exchange, all manner of other wonderful palaver over what they're going to do with the BRICS. But with an alt currency, what will that be, ladies and gentlemen? It's hard to see, and that's, of course, a topic of debate every day in Exchange Invest these days. Alt grain, alt metals, well, where will it all come from? Where will it all come together? How will it all happen? And why, indeed, are they reinventing a new world with institutions that look exactly like the old ones that the West created sometimes a century ago? Now, speaking of history, ladies and gentlemen, we're going to have a rich historical soiree this evening because I'm delighted to bring a guest this evening, Yassir Benjelloun-Touimi. He is the man who is bringing art to market. He is the CEO of Art MTF. If you don't know what an MTF is, if you're in the USA, it's the same as an ATS, a multilateral trading facility. In other words, an exchange, a trading platform. Artex is an MTF. Yassir has over 20 years investment banking experience in London with BNP Paribas, BAML and UBS, amongst others. He successfully set up two very interesting ventures in the whole world of CDS. ITRAXX at BNP Paribas, which was the first liquid credit index family. And he also set up the UBS Price Improvement Network, PIN for CDS. So with a hardcore background in the wonderful world of CDS and other things, these days, ladies and gentlemen, what he's interested in is the tokenization, the securitization, the trading of art. Yassir, welcome to IPO vid number 158. Where in the world are you today?
I am currently in Paris. Thank you very much for having me in the show.
What a joy to see you in Paris. What a beautiful city, an epicenter of the global art market over the course of many, many centuries indeed. So tell me, Yassir, how did you actually get into financial markets in the first place?
So it was back 20 years ago. I graduated from engineering school from France and did some maths and ended up working for BNP Paribas on the interest rate derivatives to build models, basically, to price options. And this is how I started in the financial market. It was back in 1997, 1998. So that was a long time ago.
1997, 1998, very interesting times, of course. We were just starting to go into the really low interest rate era.
Yes.
And we also had the Asian crisis, which drove the business. Yes. So yes. Did you go straight into CDS or did you start somewhere else and work your way towards it?
No, at the time there was no CDS, basically. We were trading bonds and interest rates basically was the most traded fixed income. I think the bond market was developed, but not as much as we know it today. And my first inquiries was really the interest rate word. And you're right, that was I mean, the interest rate cycle started to go down from 1994, and 1998 we have many crises, including the blow up of, I think, LTCM, which has a massive impact on the financial market. It was short run before of course, the 2000 tech bubble that blew out. So I started really my career in an environment with increased volatility, with high volatility, a lot of events happening every 1 to 2 years, an unsettled market on interest rate before basically we went into a moment where central banks decided to unleash their monetary tools and swamp the market with cash to basically lower that volatility, lower rate, and bring down everything, but unfortunately just push every single assets around the planet to highs we never thought they were going to be there, and pushing interest rate to negative territories, was something that we were already at my time when we were working on models for modeling interest rates. It was complicated to deal with negative interest rates. So yeah, so it was another time.
Fascinating time indeed. No, wonderful you mentioned all these historical moments like LTCM, long-term credit management, the collapse of that hedge fund, which of course was a hedge fund made up of entirely masters of the universe. As I remarked at the time, and I think it's also in my first book, Capital Market Revolution, I mean, the difficulty that hedge fund had was their mathematics were absolutely perfectly flawless. It was just a universe that had slight twists around the edges that ultimately was their undoing. Incredible history, incredible.
So the CDS came mostly in around 2003. At that time, I started basically trading. I was part of the proprietary trading desk in London, and the CDS revolution started probably around 2000, 2001. We traded the first credit default swaps, and the market really very quickly, the banks have seen the interest in managing their counterparty risk and their corporate exposure through default swaps. And we went from a quite illiquid market, and we started working on finding an index that can bring some liquidity into the market. And BNP Paribas at the time where I was really running that effort, teamed up with JP Morgan and Morgan Stanley, and with our teams, we worked on a solution which was ITRAXX, and suddenly ITRAXX became a simple solution to hedge our exposure, or people exposure to the bond market and to corporate risk and to default risk. It took a little bit of time to people to understand the use of it, to trade it, and for a lot of people to get revenue out of it. So the mitigation of risk and transfer of risk has spread itself to the whole financial system, and banks seen that as a way to really hedge themselves against a lot of events. I think we pushed it to a limit, especially back in 2008, where we created a lot of excesses of that bubble as well. But back in 2002 and 3, where we launched ITRAXX, we went from previous indices where we used to trade like 10 million a year, and suddenly I remember I was the first market maker for ITRAXX, and when the Madrid bombing happened, I think it was 11th of March in 2004, I traded probably 3 billion or 4 billion. We traded with the JP Morgan and Morgan Stanley probably 4 or 5 billion in 10 minutes. And that was really the takeoff of the ITRAXX market.
That's quite incredible to think about that taking place. And indeed, yes, having been on a train just the other week, the one thing that still happens in Madrid is that they still put you through electronic scanners before you get onto any sort of a fast train. And frankly, I understand it. It's very well run and it's very smooth, but at least they've got better privatized trains these days. So a fascinating development in that market, quite incredible. So you spent this amazing period of time in the yield curve, seeing the nascent building of the CDS business come out, right through the kind of peak for the time being of the CDS explosion, because it wasn't the bubble, but it was obviously, it was being traded around the bubble in order to try and mitigate things. And actually, incidentally, ladies and gentlemen, if you're watching this, there was a great show 3 shows ago, 155, IPO-VID 155 was with Patrick Wood, who's got something slightly different twist on the whole issue of CDS and the insurance for ratings downgrades and so on, which I thought was quite fascinating. So, I mean, if you don't mind my saying so, it's quite a quantum leap to go from CDS to co-founding Artex. So let's break that down. What brought you to the point where you'd reached sort of where you thought you'd had enough of this incredible investment banking world after a series of 3, 4, 5 AAA names, and you were looking at something different?
It was done in the time, and to be honest, there was probably the first steps. I always loved art. I was lucky enough. I, grew up in Morocco, and I went to France to study, and I was lucky to come to Paris. And Paris, when you're a student, and even if you live in Paris, you have access to art like anywhere in the world. It's free, it's accessible, especially when you're a student. You've been taken care of. So it was really something that it was not a lot of people who are born and raised in Western Europe, or I would say the Western world, are familiar with museums and art, Western art, since their youth, because they've been taken by their parents, by their school. And this is part of their cursus to understand their history. And for me, coming at the age of 17, 18, it was a completely new discovery for a new way of living, new society, new organization, new history. And that was part of the things that I enjoyed, because it felt like a deep privilege rather than something that is given to you. So my appreciation of art and the subtleties of it, when you get interested, is that it opened my mind to a new field, and I loved it. And I carried on that for the whole of my life, because I'm deeply passionate about art, but it's like a hobby. My business was finance, and basically I pursue it. And what I did when I left, so I joined UBS after, where I used to run credit trading. We started also there was always this concept to liquefy or bring more liquidity into markets. This is something I enjoyed. Even if I was running trading, I love trading. I love making markets. I find that price discovery, like a search for where the truth of things are, even if it sounds a little bit exaggerated, but it is that quest to find a trade. Where is the trade lie, where people exchange, buy and sell? And I always also have that passion for finding where a transaction can happen. So by doing it in ITRAXX and at UBS, we developed the PIN CDS platform, which is also an MTF, and where we opened liquidity and we streamed liquidity to allow everybody else to participate. And it was a great success, because most hedge funds poured in, most funds poured in, and started making markets themselves on CDSs, where we witnessed a massive increase in volume. And that led us to basically around 2000, the great financial crisis have many effects, which is one of them was that we kind of decided to kill volatility and to reduce it massively. Monetary policies, aggressive monetary policies, by bringing quantitative easing. And what it did over time is it basically decreased in such a manner the interest rates and what we got paid to commit capital. So money became for free, and it puts the whole world into a conundrum on how to price assets. If you consider that an asset is the sum of the discounted cash flow of it generates, when your discounted cash flow, your denominator is close to zero, then where is the price? And the price discovery becomes sensitive to a move of 5 basis points in interest rates. And as an investor, because I moved to the buy side and to an asset manager and become a partner in one of them, and we were struggling more and more to invest our clients' capital. And in the meantime, my interest for art has continued to be strong, and I can see this discrepancy developing between these two worlds, which is one which is a financialized world where interest rates are that low, assets are very high, and people are struggling to commit capital to anything. And the only way to make money is to leverage it to hell. And then on the other hand, a little private club where if you are a billionaire and you can afford to buy 20 million plus artworks, you will be picking up great assets and expecting to, with kind of a high certainty, that you will make a lot of money 15 years down the line. And that was probably one of the first kind of discrepancies that I see two markets. One is because of the omnipresence of liquidity is overpriced, and one is lack of presence of participants, of liquidity, of the transactions fees are high. There is nothing happening. So that's and I met with my co-founder of Artex, Wenceslas van Liechtenstein, who belongs to a family who's been collecting for 600 years. And we were aligned that thinking that why should this be a reserved matter for the richest? Why? Why shouldn't be more open to the rest of the world to benefit from basically the quality of this amazing asset that can touch us on the heart, but they can also benefit our savings.
So yes, it's very interesting because you mentioned the fact that it's a tangible asset underlying. It's something that also we ought to have an emotional involvement, engagement to, and therefore we can actually physically like it in a way that perhaps, well, we don't find the same thing with a stock or a bond or whatever, although we may feel some adoration and fondness for it if it goes up and makes us a lot of money. Therefore, okay, so you came to this crossroads, you decided to start forming Artex. How did you go about trying to create the market?
So when we started thinking that this is a market that is an interest for all of us rather than a very tiny minority, and that is prone for a kind of democratization, but also open it up for our pension to benefit from it, from our savings. We have looked at all the models that have been brought so far in order to tackle the same. I think people want that transformation to happen. There was a lot of attempts to do that. And it started really by the Bear Fund that was created back in 1974 by the British Rail Fund. And that was the pension fund of the British Rail. And they have, in their way of thinking, how can we tackle inflation rise, which probably for all people can understand that mid-70s oil had shot up massively. Inflation was increasing in a massive way. And that started basically since 1966 and finished 1984, but we were in the middle of it and people started to panic about inflation. They said, okay, let's invest into art. So they set up the first fund and they started buying everything nearly indiscriminately. And 10 years later, when they unwinded it, I think there has been a hefty return made, but was mostly generated by the impressionist part of the portfolio rather by the rest, meaning that even that strategy, which was a holistic one, non-discriminate buying of arts, have yielded a decent return that beat inflation. And since then, there has been the same concept, but that evolved over time, which is let's have a fund and a fund needs to have an investment manager, and we pay a fee to have an investment manager. And what he does is he go there, and we suppose that he knows what he's doing. So he's gonna go out there, find us beautiful artworks that will yield a lot of value, buy them directly or indirectly, mostly through auction houses, where he's gonna be paying hefty fees of transaction, put them somewhere we don't know where. And then hopefully in 5 years' time or 6 years' time, he's going to be able to sell it and take a piece of it, usually 20%, and give us the rest. And we were hoping that that would yield a nice yield. And it was a mixed experience, because a lot of those funds have remained confidential to start with. The entry ticket was like probably at the beginning 500K or even 1 million, and go down to 100K. It went, and we've been experiencing this throughout probably the last 60 years. I think the ultimate business model that went, that evolved in such and pushed the concept that far was Masterworks, which kind of made it available for everyone in the US to invest a minimum part. I don't know what is the minimum, but it's allowed to everyone to invest, and they buy artwork, they keep them, and they want to sell them down the line. And it's a private format. We thought that this model is coming to an end on the such, because it was running, and the outcome for a lot, it's not easy. The level of regulation was not appropriate. And basically there was no regulation, no protection generally, meaning on general way, no liquidity, no vision on when to exit, and basically no feeling of ownership of the artwork, because we share them all together, and there are many, and most of the time we don't know what it is. So it was not a great experience, and we thought, let's go from here and try to figure out how to fix everything that is stopping this from becoming mainstream. And we started line by line saying, okay, how do we fix liquidity? How do we fix the investment? How do we fix? And in the end, we thought the only way is to go the most complicated route, which is an exchange, basically. And the multi-trading facility, an MTF, was the right solution that was provided by MiFID II, which was a great solution, one of the innovation of Europe that worked, actually. Yeah. And that will give us actually everything we need. We're going to reduce the entry point to close to 100 euros, so that everybody can get in. We will be regulated. There's a trading venue where there is transparency on pricing, non-discrimination, whether you trade 10 lots or 10 million lots, it should be the same. It's also, so it brought us many elements. Market making basically can intervene in order to give you a liquidity that is a high level of liquidity, where you can trade anytime, buy anytime, sell anytime. You can choose which artwork you want to buy, basically because we do listings to, and those listings are one artwork for each listing. People know about it. They can trade it anytime, exit it anytime, go straight into collectors to get artwork being listed for them, to cut the intermediary cost, and find a way to involve the banking system, because the banking system brings us two things that are important. Protection for investors, because there is an oversight as a regulated entity. It gives them enough comfort at the risk level, compliance level, and that risk level will allow them to assess we are a good investment for their clients. So there is a high level of protection that is given to clients. And the second one was our ability to reach anyone and everyone around the planet. Because we are a B to B to C business, if you want to buy shares in Artex, you need to go to a broker, you need to go to a financial institution, a bank. and we have the ability to link that bank very quickly to us. So we went from what has been done so far. We try to see what are the blockers that a market of 3.5 trillion of assets only trades 65 billion a year, which is ridiculous, by the way. It's not even 2%. And how to unlock all these elements to allow more people to participate into this and to explore the liquidity, the transparency, the protection that is given.
And it becomes really, really interesting then. So walk us through how this works. Do you buy a particular artwork, or an artwork, the owner comes to you and says they would like to list it on the exchange and divides it into parts? What's the process?
So we are really focused as a solution for owners of artworks. Again, it lies within our real. If we're going to bring an asset, we are focusing on only artworks that are $35 million plus. Why? Because they are the ones that not guarantee, but give a lot of comfort of quality. That level of quality, uniqueness, and rarity is what maintain the price and making desirable over time. And we focus on the artists, the main artists, the 31st artists that have passed the barrier of time. They demonstrated that their desirability, their importance into history of art is not something that will be discussed, is established. And that was create the quality of the asset that people are buying. So that's the first one. And the second thing, we need to reduce cost of execution, meaning any cost. There is one of the blockers of creating a liquid market is transaction costs, whether it's primary or in secondary. So the best way to create that efficiency is to find a balance between an owner and the recipient that are the public, that are the buyers. And the intermediaries that we are and the banking system are, we shrinking materially those costs in order to reduce them and allow this to happen. So we are a solution that is offered to collectors. So we speak to the biggest collectors in the planet that are starting to know more and more about us. And all the artworks that we bring in and we will be bringing in the coming years are coming sourced with collectors that are at one stage or another willing to sell them. What we offer the collectors as a kind of edge is we think in average they will, because of the reduction of the costs, they will be able to achieve in average a good exit price. Not the greatest, not the lowest, but we reduce their uncertainty on their exit price. You have to think about it in a very different way. Some of the collectors bought artworks at $50,000 like 30 years ago. They're going to be selling it at $40-50 million. So they already made a lot of money out of it. Whether they exiting, they want just certainty of where this thing's going to sell. And our framework and work that we do with bank is, and we have independent valuation that will come to set the starting point, and then the demand for the artwork will probably give us a small range of flexibility between 10 and 20%, rather than they can sell it at double price or half price. So certainty around the selling price is the first one. The second one is, as a company, we have decided to support cultural institutions in their mission to transmit and conserve our cultural heritage. And one of the ways we do that is we take every single artwork that is being traded in Artex global markets, and the directors have a mission to lend it to the biggest museum or the museums around the planet for free, so that people can go and see it. It gives more visibility. It is allowed. And actually what we think is once you buy shares into an artwork, even if you want $100 shares, you create a relationship where you want to know more. This is like a power of link that want you to know more about your artists. You will be going more to museums. You will be more involved. We kind of, it's like we suck you into the art world. We're just buying a piece, or even if you don't buy it, you are interested into doing it. So for owners that have spent their life collecting, and sometimes into they are old today and their children are not interested, or they don't have children, they are interested by this idea that they want to share their artwork and their collection with the rest of the world. And they are happy a lot of time they have museums they are close to see this thing hanging in a museum. And the third part is the owners can still own 10% of the artwork, which in the beginning sometimes up to 25, but they need to go down to 10%. So for them is in 2 steps. They still keep the shares, and a lot of them are close. I would not say at the end of their life, but they're quite, and they are thinking about this thing, which are what's my succession, how I'm going to do that, etc. So we offer a solution where one is financial stability, 2 is their legacy, and basically 3 is you still involve into the artwork by owning shares, and you can benefit from the upside.
Fascinating. So I've got to dig in and ask you a few questions about the money side of this, because it's intriguing. So first of all, how are the pictures? The pictures are what, put into a separate company, and then you buy shares in the company? Is that how it works? Yeah.
Yes.
Okay.
So if we go into the details, we set up as an arranger of the transaction. You have to understand that as a company operating an MTF, we are not allowed to own the artwork or any shares in the artwork, because that would constitute a conflict of interest. So we are here just to manage that the transaction happen, and that the trading and the exchange happen in our trading venue. So we create a company in Luxembourg, a Société Anonyme, limited liability company. The whole only purpose of this company is to acquire and hold one artwork. And that company will sign a contract with the seller, whereby through the process of listing the artwork in our trading facility, the proceeds of the sale of the share will allow them to buy the artwork, basically, to transfer the ownership to the company. So what do you have? You are owning, if we are talking about 100 million euro artwork, we will issue 1 million shares at 100 euros, which would be the starting point, and people through their banks and can acquire in primary shares into a new artwork which is brought into the market. They will be owning 1 share of a company which have an asset that is worth 100 million. And that company will decide that company is governed by its director, independent directors, and that company will have an audited account every year, have incurring costs. Those costs are fully paid by Artex. Because we trade the shares, we generate revenue out of shares in a different ways. And we think that we take over, because we can make these revenues, we can pay the cost of maintaining the artwork. So in the end of the day, the asset on itself is very similar. If we take the emotional side, the history marking side, is similar than the properties of holding gold, but without the cost of carry. It's a 0 cost of carry. You hold in something that serves into diversifying your portfolio, and investing in an asset where the expected return, not sure, but the expected return according to historical analysis is always beating inflation, and it sits around 9 to 10%. That's what history is telling us.
So that's fascinating. So you get 9 to 10%, hopefully, of carry. You beat inflation historically, et cetera, et cetera. And essentially what you're saying then is that you just buy a share in the artwork, but as the shares trade themselves as part of the fee structure, you're effectively paying for the organization of each of these individual companies that run the art. So there's no, so to take it back a step, to look at it as a traditional listed exchange, there's no kind of listing fee by the company on the exchange, but you're actually basically subsidizing it, yes?
Yes, the listing fee are paid part of the transaction in the beginning, but once the company is listed, there is a setup fee that covers the first 2-3 years of managing the company, and then it is the responsibility of Artex Services, which is a subsidiary of our holding company, that arrange the transaction and will be carrying the costs going forward.
Fascinating. Now that's really, really interesting. Then there's obviously this big question. You've part answered it already, but obviously, I mean, when you've got a piece of art, you can't just stick it on the wall. And I mean, certainly I can't take it to my house in the Caribbean and stick it on the wall because it would biodegrade in minutes, quite literally, no matter even if it's a relatively new artwork. You mentioned the fact that you lend them out to museums and so on for free, but hang on a second. So let me help me understand that, because obviously if today I'm sitting with the artwork in the Musée d'Orsay and tomorrow you decide that that's going to go to, I don't know, the Metropolitan Museum in New York or wherever it might be, some gallery in New York, there's a huge amount of cost and fees involved. So how does that work in terms of the painting itself? Is that paid by the person who's going to exhibit it?
I mean, it's usually we want to keep a hand on the artwork in terms of insurance, handling and making sure that it is done in the right way. So we most likely scenario, we will take over all the costs. I give you an example, although when you lend it, it's covered by the insurance of the museum, but we didn't feel satisfied with the level of protection that it gives to investors. And we decided that it's going to be us who are covering that cost. And we can afford to cover the cost because if you look at our revenue generation, it's much higher basically than running the cost. It's multiple times what is covering just the cost of maintaining an art piece. And especially when you start having a lot of artworks, then those costs go down with time as well. My simple answer is we prefer to handle and take care of costs in order to maintain the highest protection possible for the assets and the state of the asset.
That's very interesting, because obviously you mentioned also insurance, and I know that's no mean feat, being insuring these artworks when they're very, very valuable. So that obviously adds quite a lot of cost. So that's incredible. So the exchange's own infrastructure through trading and the other revenue models you have allows you to essentially cover the cost of operating the company, moving the paintings around, but at the same time making sure, therefore, that is your social mandate, that they're seen by essentially as many people as it's feasible to see in large quasi-public galleries.
Yeah, I think for us is important that all the care and the protection is given, and this is why our level of due diligence that are present in the offering memorandum are, I would say, the most we can do. They are one of the most extensive studies to understand three things that matters: the provenance of the artwork, the quality of the artwork, meaning the condition at which the artwork is, and if it's restored, who did it and in what condition, and finally the rarity of the artworks, the fact also that we are targeting those great artworks it means that it gives us the ability to buy the level of quality, to acquire, help people acquire the kind of quality and trophies, because they are trophies that people are acquiring. And that's why we compare it to gold. It's like you buying gold, but in an idiosyncratic way. It has the same behavior. It's the return plus the diversification plus the intrinsic quality of the underlying.
Fascinating altogether. So then talk us through, give us an example of something that's already come to market, because remind me, how long have you been actually trading now?
So we started the first listing that we did it back in March 8th of this year. The first one was a Francis Bacon triptych of George Dyer, which was his muse and his lover, and belonged to this mid-60s, which are the height of what Francis Bacon has done. And the value at which it's been brought, the valuation was $55 million equivalent in euro. So we have the introduction, the listing price was 92.2 euros. And then currently I think it's 97.8. It's around 98 anyway. So it's been trading now for quite some times, and we are working to bring currently a new one, which is Gerhard Richter, and we have a plan to bring faster many in the coming months. This thing takes time. I think that the most important challenge that we faced is the speed at which we bring financial institution to become a member of the exchange or to become a distributor of the shares. So we've been working on that for years, and you can see that since 2008, they are facing as well a higher level of regulation, complexity, compliance, etc. But we have a system, we have an organization that gives them a lot of comfort at all levels. And this is why we already have more than 20 banks that are connected. And we keep growing that base to become way more important than this, with the objective that when their client would like to participate, they can have access. I think that it's important for bank, especially with bringing this new asset class that have a significance on the emotional side, on its importance on our history, that when people want to participate, they can have access. And this is what a lot of banks understand and want to participate in this, I would not say in this evolution, let's say.
So in this, I mean, it's a very interesting evolution. It's fascinating. You've got 20 banks already on stream. And as you say, you've been going for essentially only 7-8 months, something like that, since you've actually been trading. And we all know it takes a long time. Even in established products, it's going to take you at least 18 months or 2 years to establish a benchmark of liquidity. But perhaps you can share with us some embryonic indication. You mentioned the Bacon triptych, gone from $92.2 to 97, 98 or whatever. I'm not so concerned about the price appreciation. Obviously, it's lovely that it has gone up a little bit already. Give us an idea, how much kind of trading have you actually seen? Because you mentioned before, there's no trading. I mean, in the art market, 65 billion against 6 trillion. So less than 2% is sold annually in glossy, glitzy sales in Paris and London and New York. What's been the impact of actual market trading?
I mean, there was like, there are similarities that we see in mid-cap and small-cap markets, in the sense that the first stage that follows listings tends to be where most of the volumes happen. And that's what we witnessed. We witnessed a lot of volumes during the first 2-3 months. And then it went quiet because people are happy about their ownership. They see that as a long-term investment for the time being. And we have so far brought clients that are mostly ultra high net worth client, private banking client, or funds. So, I mean, the liquidity to trade is available every day. The volumes have been important in the beginning. Now that we are bringing the second one, they most probably will increase. But for me, the main moment where this thing's going to change, and we will go to a more trading volumes driven kind of asset is when the index will start. We plan to bring the first tradable index in out probably, hopefully by second quarter of next year. Again, this is our indication and target, whether it's going to happen or not, but is there, we have an agreement in place with somebody who will calculate the index, who are regulated to do so. And this index coming will create an underlying liquidity in the underlyings that will become much higher. We target between 0.5 and 1% a day in average, which is a high level. And I think once the index and the first ETF start trading, and it brings the institutional world to start trading this new asset class, then we have an increase in liquidity. So the tight bid offer is there. The volumes are still, I would say, small, on the small side. They've been important in the beginning, but they are low right now. That's the reality. And they will continue to be so because people that are buying are willing to hold the asset for a long time.
Yeah, but on the other hand, I mean, it's spectacular, isn't it? Because you're talking about potentially you've seen days with 0.5 or maybe even 1% of the value traded, which is so within 1 week you could trade as much effectively turnover. You've the same velocity as the existing established art market. I mean that's a pretty spectacular number. So it's a good start. It's a very good start. I want to jump, actually, if I may, Yassir. We got a couple of fascinating questions. I'm going to start with Anberg, an art lover extraordinary. But let me tell you, she's our commodity diva. She was a great guest on this show a number of months ago, speaking to us from Chicago, near to the wonderful Art Institute. Most intriguing, she says, assuming a single buyer wants to own a unique artwork, now split into 1 million company shares. Oh, she's down the road of M&A already. Does the holding company effectuate the share transfer? What is the state of play?
Very, very good question, because I didn't mention this part of how the M&A works in Artex. And so any holder cannot hold more than 10%. If you hold more than 10%, or you can just decide to buy the whole artwork, you need to make a takeover bid. That takeover bid, it's based on minimum premium paid that is listed in the offering memorandum. Usually the case is around 20%, which we have done for the George Dyer, we're doing for the Richter. So if you pay 20% over the last 20 days, then you could be the owner of the artwork down the line if nobody else comes within the 10 following trading days and offer a minimum premium of another 5%. And that will trigger an auction until we end up in the final price, where we have somebody that is willing to pay 130 million for this artwork. And if that's the case, he will be the winner. The company will sell him the artwork, take the cash out of him, and distribute it to shareholders. And the shares will then be delisted from the exchange, basically. We are in the same logic as we go through from company go private to public and go public to private. The only difference is once the bid is formulated, then it is mandatory to sell the artwork. You can't have minority blockages, etc. And people will say, yeah, but this is not like what we want. We want people to fight. If we don't want to, we would like to create a liquid market. We create fluid market. So this market is already very slow. It's not fluid. It's not liquid. It's not moving enough. So we have, once we conceived it with our team and our partners, we thought about how to make it very fluid, increase the velocity in the art market. And this is one of the ways to increase that, because this market can become somewhere where people acquire artworks that are stamped in terms of quality, where it's defined where what premium or what price they need to pay to get them. But they have the insurance that what they buying is authentic, is have a great provenance, been well described in studies, and that the evolution of price has been quite visible over the recent year of tradings.
That is a fascinating answer and a very, very interesting insight into the structure of the business. So thank you very much, Yassir. Thank you, Anne Berg, for such a fascinating question altogether. And I want to go quickly to another great question we have from Sarah Bastier-Toromino. She says, great show. Do you have a market maker for these trades?
Yes, we have today two market makers and in providing liquidity. They are streaming that liquidity in different sizes, I would say, and that's been happening since the issuance. That's one of the conditions, actually, that as a regulated entity, we provide liquidity and promote liquidity into the trading. So yes, there is market makers, and we have an agreement with them. And that agreement is what drive their ability and how they're going to make money in making markets on this new asset class.
Fascinating, fascinating altogether. So in essence, you have a huge model of something that is very, very similar to a traditional exchange, but at the same time, you have some fascinating tweaks because you're taking a lot of the costs of running the artworks and the artwork companies year in, year out, and essentially paying those from the fees that the exchange generates, which is a different model to that which we've seen previously on a lot of stock exchanges. So that's quite fascinating. How did you come to that model?
I mean, we worked for the last 4.5 years. Trust me, the way the end of the road today is very different from anything we imagined with our team and partners 4.5 years ago when we started. And the innovation usually comes with 40,000 changes that you made and you adjust while you go into a process where you keep changing. And those changes, those tweaks, while we keep understanding what is missing for the artwork, while discussing with the banks, how do we make this product available and beneficial for end customers? And this is why we tweaked it in a sense that we maintain the objective of liquidity, how to make money. People will be invested and make money, how to support financial, cultural institutions as well, because it's a fine line when you start walking between art and finance. This collision can not necessarily the most healthy one, but we're trying to make it actually beneficial for all, so that we understand that why this is a financial product, it just draw more people into the art world, which is beneficial for all of us, for artists, for museums, for our lives. So this is more a way to find a way to link these two worlds, basically, and link them in the right way possible.
Fascinating altogether. So Yassir, I mean, you've given us a great overview of how Artex works, your vision for Artex and all of your background. You yourself were once upon a time a capital market revolutionary. You probably didn't realize it even before Artex in building the ITRAXX index and things like that. Now you're building this incredible revolution and evolution at the same time in the art market. It comes to the final question of the day. Yassir, where do you think the capital market revolution goes next?
I will speak about many aspects of our life have interlinked, which include the financial markets. I think the way you can look at it, I have a daughter. I love my daughter, and I'm worried about her future, what kind of future she will end up being. And we are at a time where there is so many things that are happening in the same time: the AI revolution, the climate issues that we are facing, the speed at which things are changing generally. We have entered an era where it creates so much uncertainty and so much possible accident in it. And I'm glad today that what we are doing indirectly, which is being involved in the art market, that is a symbol of unison between people, is a uniting force. Art is uniting, art is appeasing, art will give us perspective from a historical perspective. So being involved in something that can change or improve people's life by increasing the dose of art of their life, whether it's through an exchange or whether through something else, but at least this strong point of reference that allow us in a world that is changing so quickly and so dangerously, because it's dividing as well. Very few people can cope with that level of change, and most of the people will be left behind and need a new organization of society. While if you look at the number of revolutions that are coming, they are just ongoing, and we don't feel the speed at which they are transforming. So into this massive transformation where a lot of uncertainties are, I am with my team, with the people that we work every day, we are proud to participate somehow on bringing something that is, I would say, a dose of love in their life, a dose of beauty on their life, these ideas that open up and allow us to see the beauty in things that take our brain off of the stress of a daily basis, of the stress of our future. And that's is important for us. That's how we see our mission as a company, basically.
Well, on that rising note, thank you very, very much, Yassir. It's been an absolute pleasure to chat with you today. A fabulous conversation with Yassir Benjelloun-Touimi. You're very, very welcome. Thank you too to all those who've made comments. I'm so sorry, Cyril Xiangqi. I'm afraid I didn't actually see your comment come up in our feed, but I've been told you did make a comment. I'm sorry if we didn't get to that on screen. Anberg, Serabastia Turamino, thank you very much for your comments as well. Let me just add very, very quickly, our book of the week is Commodity Price Dynamics by the fabulous Professor Perron, Craig Perron, a previous guest on this show. And that leaves us to look at next week's show, which is going to be a fascinating look towards the US retail equities trading, bringing that into focus with Cody Asmoon, who's building a very, very interesting new venue for that product. And it remains for me only to say thank you to our fabulous production team today, to Fernando, to Natalie, and to Kim for your excellent work. This has been a fabulous IPO vid with Yassir Benjelloun-Touimi talking about Artex. What a fascinating market, ladies and gentlemen. I look forward to seeing you prospering in the future and bringing the art markets to many more people across the world. Good luck with that. Thank you very, very much, Benjamin. My name is Patrick L. Young. Join you during the week on exchangeinvest.com. Anytime you've got a chance, you want to keep up with the business of bourses, whether they're in art, fine art, or whether they're in commodities, stocks, whatever. And of course, if you've got any markets that you'd like built, then send me a direct message. My name is Patrick L. Young, wishing you all a great week in life and markets. Thanks for watching. See you next week.